Today, my friends and I will presentation about bookkeeping cycle. The first material, what is an bookkeeping cycle? The accounting cycle is a series of steps that a company follows to record, classify, and summarize its financial transaction for a given period. Cycle means the occurrence of events in a systematic and repeated the same periodically. According to Bahri 2020, quoted from Uswatun Hasanah, Siti Zafar Sekia, Wirda Mawada, and Iskandar Muda. The accounting cycle is the stage from the occurrence of transaction to the preparation of financial statement. So, ready for the next record. The cycle typically includes processes such as journalizing transaction, posting to general ledger accounts, adjusting entries, preparing financial statements, and closing the books for the period. Accounting requires recording and summarizing business and financial transactions. The information then needs to be analyzed and verified, and the results report through financial reports. The accounting cycle is important for companies because it allows them to accurately track their financial transactions and ensure that their financial statements are accurate and reliable. By following a consistent process for recording and summarizing financial data, companies can easily monitor their financial performance and make informed decisions about future investment and operation. By following this cycle, companies can prepare and submit accurate financial reports to stakeholders, such as investors, lenders, and tax authorities in a timely manner. This can help to build trust and credibility with stakeholders and will ultimately support the long-term success of the company. Next material step in the accounting cycle. Step 1, business transactions are created. Source documents are created, receipts, bills, and check. Step 2, analyze and record the transaction. Information is placed in the journal by account name. Step 3, post the information from the journal to the ledger. Information from the journal is recorded into the general ledger. Step 4, prepare a trial balance. The trial balance is a listing of balance in the accounting of the general ledger in order of asset, liabilities, owner equity, revenue, and expense account. Step 5, journalizing adjusting entries. There are no source document. Adjusting entries are completed at the end of accounting period to match the proper revenue with expense in the period. Step 6, post adjustments from the journal. The ledger adjusting entries from the journal are recorded into the general ledger. Step 7, prepare an adjusted trial balance. The adjusted trial balance reflects only adjusting entries. If an error has occurred, we know it was made in the posting of adjusting entries. Because the trial balance was prepared at the end of the month. Step 8, journalist closing entries. Close out are temporary accounts. These accounts begin the next account period at zero. They have no balance at the beginning of a new period. See page 8 for a definition of temporary accounts. Step 9. Post-closing entries from the journal to a ledger. Closing entries from the journal are recorded into the general ledger. Step 10. Prepare a post-closing trial balance. Post-closing trial balance will show only permanent accounts. See page 8 for the definition of permanent accounts. Step 11. Prepare the financial statements. The two basic statements are the income statement and balance sheet. That's all for me.
Alright friends, this time I will explain the benefits of the bookkeeping cycle. Benefits of the bookkeeping cycle according to Eric and Gabriel in 2012. The bookkeeping cycle helps managers understand the financial condition of a company and make the right decisions to improve performance. Here are 5 main benefits of the bookkeeping cycle. First, accurate financial reports. It helps record transactions neatly so that reports such as profit and loss statements and balance sheet can be trusted. Second, it supports decisions making. It provides timely financial data so management can make better decisions. Third, compliance with the law. It helps companies meet legal obligations such as tax and official reports. Fourth, error and fraud detection. It can detect mistakes or fraud through complete transaction records. Fifth, better financial management. It gives a clear picture of the company's finance, such as cash flow and cost-saving opportunities. So, in conclusion, friends, the bookkeeping cycle is important to keep a company's finance organized and to help management make more effective decisions. Next material, how the bookkeeping cycle helps companies in decision making. So friends, the bookkeeping cycle is an important process to maintain the accuracy of a company's financial records. The data from this cycle helps management make better decisions. Here are some benefits of how the bookkeeping cycle helps companies in decision making. First, budget planning. It provides financial data to create and plan budgets effectively. Second, cash flow management. It helps manage income and expense, including when to pay bills or receive payments. Third, financial analysis. It provides data to analyze trends and patterns, which is useful for pricing, product, and marketing strategies. Fourth, tax planning. It helps prepare tax reports and identify deduction or tax credit. Fifth, risk management. It identifies customers who are slow to pay in order to reduce the risk of uncollectible accounts. So friends, in conclusion, the bookkeeping cycle provides accurate financial data to support sound decision making. This allows companies to improve financial performance and achieve their business goals.
Okay, now I will present part 2.5 and part 2.6. First, I present part 2.5 about challenge faced by companies in carrying out the bookkeeping cycle. Running the bookkeeping cycle can be a challenging task for business, especially small business. Some common challenges that companies face include: have a 6K challenge. 1. lack of expertise. Bookkeeping requires specialist knowledge and expertise. Companies that do not have qualified and experienced bookkeepers may struggle to maintain accurate financial records. 2. Time consuming. The bookkeeping cycle involves several steps and can be a time consuming process. Companies may find it difficult to allocate the times and research needed to carry out the bookkeeping cycle. 3. Inadequate technology. Bookkeeping often involves the use of accounting software to manage financial records. Companies that do not have access to modern accounting software may find it difficult to run the bookkeeping cycle efficiently. 4. Errors and omissions. Bookkeeping requires attention to detail and accuracy. Errors and omissions in financial records can result in inaccurate financial statements, tax liabilities, and other financial issues. 5. Compliance issues. Bookkeeping must comply with various regulatory requirements, such as tax laws and accounting standards. Companies that fail to comply with these regulations can face legal and financial consequences. 6. Cybersecurity risks. Bookkeeping often involves the use of sensitive financial information such as bank account details and credit card numbers. Companies that do not have adequate cybersecurity measures in place may be at risk for financial fraud and data breach. Impact of challenge. If companies fail to often overcome the above challenge, it can result in: first, inaccurate financial reports; second, unfulfilled tax obligation; third, other financial problem; fourth, damage to the company reputation. Running the bookkeeping cycle can be a challenging for business. Therefore, it is imperative for companies to overcome these challenges and build an effective bookkeeping cycle process and maintain accurate financial records and make informative business decisions.
Okay, here I will explain about how can company optimize the bookkeeping cycle. There are several ways the companies can optimize the bookkeeping cycle to increase the efficiency and effectiveness of their financial operation. That is the first one, automate bookkeeping process. Companies can leverage technology to automate the bookkeeping process, such as account payable and account receivable, and reduce manual data entry. Automation can help eliminate error and streamline process. The second, use cloud-based accounting software. Cloud-based accounting software enable companies to share their financial data from anywhere, anytime, and collaborate with their accounting team in real time. It also helps to reduce the risk of data loss and provides better security for financial information. The three, implement a document management system. Company can implement a document management system to manage invoice, receipt, and other financial documents. This system can help improve the organization of financial data, reduce manual data entry, and streamline the bookkeeping process. Therefore, outsource bookkeeping. Companies can consider outsourcing bookkeeping to a professional serving provider. This can help free up time and research, reduce errors, and ensure compliance with accounting standards. The fifth, regular reconciliation account, such as bank statement and card credit card statement, can help identify errors or fraudulent activity, ensuring the accuracy of financial data. The sixth, train accounting staff. Providing training to accounting staff on new technology and accounting standard can help improve their efficiency and effectiveness in bookkeeping processes. Overall, optimizing and the bookkeeping cycle can help companies improve their financial operation, reduce errors, and save time and resources.
I will continue with the next materials. The first one is about the impact of error in the accounting cycle on the company's financial performance. Impact on a company's financial performance. Here are some ways that error can affect an company financial performance. So the first impact is one, mislead financial statement. Example, manipulation of asset values. 2. Completion issue. Example, failure to comply with tax regulation. 3. Innovation operation. Example, slow and wasteful protection process. 4. Risk of fraud. Example, financial statement fraud. 5. Poor decision and making. Next, the second material is cases and solution. So, there are two cases and two solutions. The first one is the cases of Garuda financial statement. Garuda Indonesia in the years 2018 financial report caused controversy after reporting of profit including a part received from on Unifi's Wi-Fi project. Two commissioners claimed the report did not comply with accounting standards, prompting government and auditor review. So, there are 5 solutions, which are 1. Improve transparency and accountability. 2. Strengthen integrity and ethical leadership. 3. Collaborate with authorities and legal institutes. 4. Improve operational performance. 5. Transparency and communication with the public. The first two, case of error in recording Indopharma financial statement. Indopharma made financial reporting error in the years 2002 due to accounting standards, costing and years-end stocking, resulting in a loss of 20 billion and 97 million rupiah. PEPAM has not imposed station and is investigating with here the error was caused by the accountant or management. The 5 solutions are 1. Identification of causes. 2. Error correction. 3. Conducting internal investigation. 4. Audit reports. 5. Preventive measure. This is the end of my presentation. Thank you.